Oil routes, AI earnings, and central banks are pulling markets in opposite directions today, even as global equity indices sit at fresh highs. Welcome to vTalkInsight, Equity Pulse Daily for May 28, 2026. We will unpack how those forces are shaping risk and opportunity across sectors. Global equities are pushing deeper into record territory, with the S&P 500, Nasdaq 100, and Russell 2000 all recently setting new highs. That strength sits alongside stubborn inflation, rising bond yields, and a central bank backdrop that is more hawkish in tone than in action. Earnings remain the core support. S&P 500 profits are projected to grow roughly 24% this year and 13% next year, with technology earnings up well over 30% and the broader AI complex delivering around 66% growth against roughly 12% elsewhere. Forward price to earnings multiples holding near the low 20s. Alongside this earnings momentum, help explain why several major Wall Street houses have lifted S&P 500 targets toward 8,000. AI capital spending is also acting as a positive shock to growth, estimated to outweigh the drag from higher oil by about 2 to 1. Against that, inflation is not going away. Core and headline personal consumption expenditures are expected to rise about 0.1 to 0.2% month-on-month, with core likely stuck above 3% year-on-year through December, well above the Federal Reserve's 2% goal. Markets largely see no case for near-term Fed cuts, but also limited appetite for fresh hikes while wage growth stays contained and hiring cautious. Treasury, mortgage, and swap yields have been grinding higher, reflecting concern that inflation will prove persistent even as growth holds up. Other central banks echo this stance. The European Central Bank may deliver one or two largely symbolic moves. The Bank of Japan is suddenly seen as more likely to hike on oil-driven inflation, and policymakers broadly prefer to talk tough, while hoping growth headwinds cool prices for them. That mix leaves equities finely balanced between an earnings upgrade story and a budding stagflation risk. Volatility gauges such as the VIX remain in the mid-teens, hedging demand is low, yet some allocators report cash levels around 7%, signaling quiet caution beneath the headline risk appetite. Geopolitics is the main swing factor that could tilt this balance. Military strikes by the United States and Israel on Iranian assets, combined with intensified action in Lebanon and fresh Russian threats in Ukraine, have turned the Strait of Hormuz into a choke point again. Almost 2,000 ships are reportedly waiting, and the disruption is spreading from fuel into wider commodities and even grocery prices, with larger economies now in the firing line alongside vulnerable states. Proposals for Iran to charge tolls on transiting vessels and the need for heavy United States naval protection underline the fragility of these routes. Oil has traded on these headlines almost tick by tick. Strikes on Iranian targets pushed Brent higher, but reports of a possible memorandum of understanding between Washington and Tehran and talk of fully reopening oil trade triggered a near 5% drop in crude, with West Texas Intermediate down over 4%. That optimism is fragile. The White House has publicly denied that a final deal exists, and negotiations remain stuck on core issues from control of the strait to the handling of roughly $24 billion in frozen assets, to nuclear oversight. Trust is low, timelines are vague, and a comprehensive agreement still looks distant. If disruptions extend beyond July, Europe in particular could struggle to refill gas storage ahead of winter, hardening a stagflationary backdrop. Rising energy prices are already feeding into headline inflation, complicating central bank messaging and keeping a risk premium embedded in bond yields and equity discount rates. Markets are acutely sensitive to where oil settles this summer. Many see sustained upside in equities as more plausible if crude remains below roughly $100 to $110 a barrel, while any renewed spike above that range would challenge valuations, risk appetite, and the idea that inflation is under control. Within equities, the clear engine of this rally remains AI and semiconductors. Asian markets are printing record highs led by technology and a spectacular surge in memory names, while in the United States, the S&P 500, Nasdaq, and Russell indices are all at or near records, with recent gains overwhelmingly concentrated in tech. Over the last month, technology has been the only major sector to outperform the index, and semiconductors have become the single largest industry group in the S&P 500. Market breadth is just above 53%. Momentum factors have beaten the global benchmark by roughly 17 percentage points since March, and hedge funds are leaning into that trend. The most extreme action is in memory. SK hynix has rallied so far that its market capitalization has pushed through $1 trillion after an astonishing 1,000% gain over the year, while Micron's value doubled from $500 billion to $1 trillion in just 48 days, easily outpacing Nvidia's earlier ascent. Underlying pricing reflects that surge. Spot DRAM prices have jumped about 600% since August. High bandwidth memory is expected to roughly double in price next year, and hyperscalers are locking in long-term supply, often committing capital upfront. Capacity is effectively sold out through 2026 against a backdrop of underinvestment that keeps supply tight. Despite those moves, many memory makers still trade on forward price to earnings multiples that look modest against their new growth trajectories, which is feeding a structural re-rating narrative. Micron's long-term agreements with major cloud customers are seen as limiting downside earnings risk, and some analysts now project its market value could double again within 12 months. At the same time, trading in Micron has gone parabolic, with daily share volumes quadrupling historical norms and options activity surging, underscoring how speculative this corner of the market has become. The memory business is still cyclical. A slowdown in AI capital spending from players like Microsoft could quickly cool revenue growth, and recent chip smuggling allegations and Taiwan's crackdown on illegal exports to China highlight how geopolitics and regulation could disrupt the supply chain. The rest of the AI stack shows a similar mix of structural tailwinds and emerging bottlenecks. Marvell Technology has lifted its fiscal 2027 sales outlook to around $11.5 billion on data center demand. ESML retains a multi-generation lead in critical lithography equipment, and averted strike action at Samsung has removed one immediate threat to memory output. On the infrastructure side, surging compute demand is running into power constraints. The retirement of nuclear and older gas plants has created a shortfall in reliable base load, pushing data center operators toward long-dated, investment-grade power contracts and even premium pricing for dependable electricity. Players like Applied Digital, with multiple campuses under development but only a small fraction of contracted capacity online, together with infrastructure providers such as Dycom and hyperscale spenders like ByteDance, illustrate how AI is pulling through a massive build-out in digital and energy assets. Beyond chips, software is now showing sharp dispersion between winners and laggards. Snowflake surged more than 25% after announcing a $6 billion multi-year chip purchase agreement with Amazon Web Services, raising full-year product revenue guidance to about $5.84 billion and improving margin targets, all of which reinforced its role at the heart of the AI data platform ecosystem. In contrast, Salesforce delivered softer guidance and admitted that its Agentforce product, while strategically important, is not yet material to growth. Management's hopes for a near-term revenue re-acceleration increasingly look pushed toward 2027 as enterprise clients test AI tools before shifting spending models. Zscaler fell over 21% after weaker forward revenue guidance and slower new customer growth, reminding the market that it has little tolerance for deceleration, even in high-priority areas like cybersecurity. These dynamics are feeding a broader rotation pattern. Investor flows have moved out of software as a service and into chipmakers in the second quarter, even as some observers argue that industrials and utilities now offer more attractive combinations of earnings growth and valuation after underperforming the AI complex. Banks are also lagging, despite being positioned to finance AI infrastructure, bond issuance, and rising merger activity. For now, semiconductors and a handful of AI leaders are carrying the index, while much of the rest of the market grinds sideways, leaving portfolios more exposed to a narrow set of growth drivers than headline indices suggest. On the household side, the wealth effect from surging AI and semiconductor stocks is boosting spending among baby boomers, who control the bulk of financial assets and have helped push GDP growth above earlier expectations. Yet nominal wage growth has not kept up with inflation, so real purchasing power is being squeezed, especially for less asset-rich groups. Retail equity signals reflect that split. Companies like Abercrombie and Fitch and Bath and Body Works are being rewarded for protecting margins even as sales growth slows, whereas Dick's Sporting Goods has come under pressure after cutting its full-year outlook despite beating first-quarter numbers. Upcoming results from Dollar Tree, Burlington Stores, and Best Buy will be watched closely for fresh read-throughs on consumer health, while Lululemon's 60% share price decline and leadership churn underscore how brand-specific execution risk can dominate even in once premium categories. In energy, BP's abrupt removal of its chief executive after only 8 months, on top of multiple leadership and chair changes in recent years, keeps governance questions front and center and fuels speculation about future strategic shifts or consolidation. Activist pressure has already pushed the firm to refocus on core assets. In Europe's industrial and auto complex, idiosyncratic news flow is also moving stocks. Volvo has rallied after indications it will avoid a United States ban on China-linked connected vehicles, highlighting the value of a diversified global manufacturing footprint. Akzo Nobel jumped after rejecting offers from Nippon and Sherwin-Williams, with investors now speculating about a potential merger with United States-based Axalta in a coatings sector that remains ripe for deals. Another powerful theme is the reopening of primary markets and the evolving role of indices. The Nasdaq reports a strong pipeline of multi-billion-dollar listings across defense technology, AI, healthcare, and consumer sectors, and has already attracted high-profile moves such as Walmart and Shopify shifting or adding listings. Index providers are racing to keep up. New rules at Russell allow large IPOs to join benchmarks after just 5 trading days, while the Nasdaq 100 can now fast-track names like SpaceX into the index within about 15 trading days, aided by a shift from percentage-based to dollar-based float thresholds that better accommodate mega-cap offerings. SpaceX sits at the center of this discussion. Anticipation around its listing is intense, with retail demand already very strong, but major public pension funds have raised concerns about board independence, insider transactions, and heavy reliance on government contracts, all in the context of a potential Tesla-SpaceX merger that some fear would further entrench the so-called Elon Musk premium. Because the Nasdaq 100 does not require profitability for inclusion, high-growth but loss-making companies such as SpaceX can enter quickly, unlike the S&P 500. Some institutions are even exploring custom indices that would exclude it, underscoring the debate about how far benchmarks should go in policing governance and concentration risk when low-float, founder-controlled firms become default holdings for passive capital. At the index level, Nasdaq has now overtaken the New York Stock Exchange in total market capitalization and hosts 9 of the world's 10 largest listed companies, cementing its position as the home of the innovation trade. That concentration amplifies any swings in the AI complex for global benchmarks. Retail participation has risen to around a quarter of United States trading volumes, up from roughly a tenth 5 years ago, with many individuals using option strategies for income and protection. Combined with professional momentum exposure, stretched valuations in semiconductors and tech, and widespread fear of missing out, this helps explain why demand for downside protection remains subdued even as some allocators quietly raise cash. Market structure itself is evolving in ways that could both deepen liquidity and introduce new stress points. The Securities and Exchange Commission's approval of 23-hour, 5-day trading raises questions about thinner overnight liquidity and larger gaps when geopolitical news breaks, even though current extended hours already cover most of the day. Outside public equities, investors are increasingly trying to exit private credit vehicles, particularly those exposed to riskier technology loans and AI-related disruption, prompting withdrawal gates at managers such as Vista Equity Partners. At the retail interface, Robinhood's move to allow external AI agents to trade client accounts marks a significant technological shift, but also adds operational and regulatory risk, with the firm making clear that end users remain responsible for any AI-driven mistakes. Putting it all together, global equities are trading near all-time highs because earnings, especially from AI-linked businesses, remain exceptionally strong and capital spending on digital and power infrastructure is still accelerating. At the same time, the backdrop is increasingly defined by persistent inflation, a higher-for-longer rate narrative, and unresolved geopolitical flashpoints from the Strait of Hormuz to Ukraine. Leadership is narrow, with semiconductors and a handful of AI beneficiaries driving most of the gains, while many other sectors lag despite respectable fundamentals. Flows into momentum, the reopening of IPO markets, and structural changes in index design and trading hours are amplifying both upside potential and the risk of sharper reversals. From here, the key signals to watch are energy prices and Hormuz headlines, upcoming PCE inflation and housing data, guidance from AI heavyweights on capital expenditure, and the tone of central bank meetings over the summer. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.